Welcome to this explainer. Today, we're going to impartially break down CoreCivic's Q1 2026 financial results, operational shifts, and capital strategies pulling straight from their latest earnings data. We're going to look really closely at how changing federal enforcement strategies, a major recent acquisition, and some very targeted capital deployments are shaping the trajectory of one of the largest government solutions companies in the United States right now. Let's get right to it. Here is our roadmap for today. We're organizing this massive amount of financial data into 6 clear strategic pillars, starting with their market profile and wrapping up with their 2026 outlook. Pillar 1, CoreCivic's market profile. Let's set the stage. To really understand the numbers we're about to look at, we first have to ground ourselves in the sheer scale of CoreCivic's footprint. This is a massive entity. We're talking about managing over 55,000 individuals every single day on behalf of their government partners. As of mid-2026, the company sits at a $2.29 billion market cap globally, with the stock hovering around $23.21 a share. To put that operational scale into perspective, it takes a workforce of more than 13,000 professionals just to keep this vast network running. And their recent market cap trajectory has honestly been pretty dynamic. They had a dip down to $2.05 billion in 2025, but 2026 is showing a remarkably strong recovery, pushing right back up to $2.29 billion. This rebound isn't random. It's a direct reflection of shifting operational dynamics and new contract activations that we are just about to explore. Moving right along to Pillar 2, Q1 2026 operational performance. These numbers really tell a story of rapid scaling. The absolute standout figure here is a staggering 74% increase in adjusted earnings per share. That's a vital measure of core profitability, and they jumped from 23 cents in the first quarter of 2025 all the way to 40 cents this quarter. That is a massive year-over-year leap, beating average analyst estimates by a full 12 cents per share. Another absolutely crucial metric here is their adjusted EBITDA. Think of that as essentially their cash profit from core operations before the accountants get in there with interest, taxes, and depreciation. That metric surged 36% to $110.1 million. Again, beating analyst estimates, this time by over $13 million. Their total revenue also jumped nearly 26% to $614.7 million. So this wasn't just a slight edge out, it was a substantial outperformance. But why the sudden surge? Well, the crucial point is that this financial leap was physically driven by the successful reactivation of 4 previously idle facilities. As CEO Patrick Swindle pointed out, facilities in Tennessee, California, and elsewhere were brought back online specifically to meet surging federal demand. Turning the lights back on at these massive, specialized real estate assets translates incredibly fast into significant revenue. That brings us to Pillar 3, population trends and challenges. Managing government contracts means you are constantly navigating shifting populations. The flow of individuals into these facilities depends heavily on federal enforcement strategies and agency budgets, which, as you know, can change rapidly. Look at this fascinating contract mix shift. On one hand, a massive $128.1 million jump in ICE revenue, an increase of over 96%. But contrasted right against that is a $12.2 million drop in U.S. Marshals revenue. This is simply due to changing federal allocations. Shared facility capacity was handed over to ICE, combined with fewer overall apprehensions at the southern border, which naturally affected Marshals numbers. And this timeline perfectly illustrates just how volatile government contracting can be. Nationwide ICE populations hit a historic peak in January of roughly 70,800. But then what happened? A government DHS shutdown coupled with redeploying ICE agents to TSA checkpoints caused a really sharp drop of 10,500 individuals by early April. CoreCivic themselves saw a drop of about 3,000 individuals in their care. Still, management views this as a temporary event-specific blip and expects a sequential rebound later in the year as federal budgets stabilize. Which brings us to a key industry term you definitely need to know, the turnkey facility. This is a fully operational facility ready to go on day one. It's vital right now because ICE has publicly stated they are considering acquiring such fully operational sites outright to build a consolidated national network. For a company like CoreCivic, which owns highly specialized, difficult-to-replace real estate, this opens up some very interesting strategic avenues to either sell assets or negotiate lucrative long-term managed-only contracts. All right, Pillar 4, the CSP acquisition strategy.
Pivoting away from federal contracts for a second, CoreCivic is actively diversifying. They aren't just relying on government bed counts anymore. In April 2026, they acquired Clinical Solutions Pharmacy, or CSP, for $148 million. This is no small side project. It's a massive mail-order operation serving 600 correctional facilities across 28 states, filling roughly 60,000 prescriptions every single day. Plus, half of their shipments are fully automated, which gives them a tremendous technological edge.
Now, you might be wondering, why on earth is a facility operator buying a pharmacy business? At first glance, it seems like a bit of a leap, doesn't it? But the answer lies entirely in the demographics. As correctional populations age, the demand for complex, chronic medical care absolutely skyrockets. This creates a highly complementary standalone growth engine for CoreCivic. CSP is projected to generate between $215 million and $230 million in 2026 revenue alone. Management expects this side of the business to grow at a compound annual rate of over 10%, effectively diversifying their cash flow away from purely detention-based revenue. It's a really smart play. Let's look at Pillar 5, capital allocation and buybacks. How a company spends its cash tells you exactly what leadership thinks about the future. CoreCivic's board aggressively increased its share repurchase authorization to a staggering $700 million. Management made it crystal clear on their earnings call. They strongly believe their stock is heavily undervalued right now compared to the real depreciated replacement cost of all that massive real estate they own. Their rapid capital maneuvering in Q1 was something to see. First, they got back 2.3 million shares. Then, they used cash and revolving credit to fund that $148 million CSP pharmacy acquisition. And almost immediately after that, they secured a $100 million incremental term loan, essentially locking in fresh, long-term borrowing to replenish their available cash. This ensures they maintain maximum balance sheet liquidity. They are keeping their powder dry, giving them the flexibility to weather any government delays while continuing to buy back cheap stock or hunt for future acquisitions. And finally, Pillar 6, the updated 2026 financial outlook. Bringing all these diverse elements together, the contract volatility, the new acquisitions, and that strategic financing, the revised guidance shows upward adjustments across the board. Despite the temporary drop in ICE populations we talked about, they've actually raised their adjusted diluted EPS guidance to between $1.53 and $1.63. On top of that, adjusted EBITDA is now projected to land between $453.8 million and $461.8 million. So the big takeaway here is that their business model proved incredibly resilient this quarter. The new pharmacy acquisition, coupled with the activation of their Midwest Regional Reception Center out in Kansas, are more than making up for the temporary, policy-driven dips in ICE populations. Structurally, they are in a higher position today than they were just a few short months ago. We'll leave you with this final provocative thought. CoreCivic still has 5 idle facilities right now. That represents 7,000 empty beds just waiting to be activated. As government budgets inevitably solidify later this year and federal agencies go hunting for those turnkey solutions, will CoreCivic's aggressive strategy of keeping those 7,000 idle beds ready to go prove to be the ultimate catalyst for their next massive wave of growth? It's absolutely a space we will be keeping a close eye on. Thanks so much for joining us for this explainer.